Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save you money. My job, not just to entertain, but to put everything into context. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. When you've moved up as much as we have since the post-Liberation Day lows, you better hope that earnings can justify that run. Today, though, the earnings came up short. While there were many bright spots, there were enough negatives to offset any talk of a potential trade deal with China or the strength of the economic data or the continual parade of takeovers that would have been blocked by that previous administration. They wouldn't even thought about doing them. And that's why the Dow lost 205 points, the S&P dipped 0.3%, and the Nasdaq declined 0.38%. In fact, on the eve of a wait-and-see Fed meeting, there was enough negativity about some parts of the economy, especially the consumer, that you might wonder if Jay Powell should simply do what the president wants and cut interest rates. Only some strength in a handful of industrials and techs seem to cut in favor of standing pat today. You know what? That might not be enough. Let me start with the negatives because they are visible, they matter, and they cut President Trump's way. Today, three very big household name companies reported jarring quarters that made me feel like the stock market's becoming divorced from some real problems out there, problems that should have been obvious given all the tariff turmoil. Consider the following from Carol Tomei, CEO of United Parcel Service, after reporting a dismal quarter. Quote, despite uncertainties around trade policies in the second quarter, the overall economy remained resilient, end quote. Hold it, just a second. Here we go. Quote, but our sector, specifically the U.S. small package segment, was unfavorably impacted by U.S. consumer sentiment that was at historic lows, end quote. Wow, very bad. Historic. A win for the president in this tiff with the Fed. It gets worse. Quote, on the commercial side of the economy, manufacturing activity in the United States remains soft, end quote. Average daily unit volume declined by 7%. Now, I know the UPS had its problems. Its profitability has been hurt by the labor agreement the company reached 2 years ago. Its pivot to cut dependence on Amazon traffic hurt. But Big Brown is a huge company that controls a major chunk of American shipping. So when its stock plunges more than 10%, I regard that as frightening. Not only did UPS present plenty of evidence of a weakening consumer, it also documented how the tariffs are already beginning to hurt consumer sentiment and consumer spending. Now, it kind of took my breath away when CEO Tomei pointed to some very strong business between lots of countries that did not include the United States. It was among the first quarters where I heard the damage that's being done to American commerce by our tariffs, damage that's not being replicated in country-to-country business that are not impacted by new tariffs. Alas, but UPS wasn't the only one. Whirlpool, which was supposed to be helped by the tariffs, at least eventually, instead got walloped by them. I crushed. Ugly. Whirlpool's last man standing when it comes to appliances, the only one that's still domiciled in this country. But the big appliance makers from South Korea and China, they're not dummies. They knew they'd struggle with the tariffs on their countries. So they front-loaded their inventory, shipping lots of appliances here ahead of time. The result? The foreign onslaught crushed Whirlpool. Sell, sell, sell. It reported an astonishingly weak quarter, taking its earnings forecast down from $10 per share to the $6 to $8 range. Worse, they took a meat axe to their dividend, cutting the quarterly payout from $1.75 per share down to a shocking 90 cents. Let's call it a collaterally damaged situation because tariffs were meant to help Whirlpool. Instead, they blew up the dividend, which, when you include a dismal outlook, is why the stock was down an astonishing more than 13% today. Oh, and if that wasn't enough, Stanley Black & Decker, another name. Look in your house. You've got these really, really just, whoa. It shocked me. A weak consumer who seems to have backed away from do-it-yourself projects, coupled with inevitable $800 million tariff hit as the company imports a huge amount of product from China and the so-called reshoring safe haven of Mexico. It took my breath away. As I read over the quarter, all I could think about was that Stanley Black & Decker is the kind of company that President Trump was trying to punish for moving too many jobs overseas. That's some real punishment, with the stock down 7% today.
The House of Pain.
UPS, Stanley Black & Decker, Whirlpool. They form a trio of well-known household companies that tell me this economy might be substantially softer than we think, at least in part, when it comes to consumer and some heavily tariffed businesses, which means the Fed might really need to think about cutting rates to offset the damage and cutting sooner rather than later. These companies are experiencing the true worries we had about the tariffs while they were being slapped on earlier this year. It's entirely possible that the negative effects are one-time only and will go away as we get more trade deals. But right now, we're in the thick of it. You know what? It just doesn't feel good. And honestly, it's hard to dismiss them as one-off when even fintech giant PayPal revealed slower growth in payments, blaming tariff fears. The chief financial officer, Jamie Miller, said, and I quote, "We observed a slight softening in retail spending in the U.S., most apparent in areas likely impacted by tariffs," end quote. After all the robust consumer spending we saw when the banks reported 2 weeks ago, I was surprised by the news from PayPal. So was the market, with the stock falling more than 8%? I say, ouch.
The House of Pain.
When you rally as hard and as high as we have, you really can't afford to see this kind of weakness. Today's earnings made me feel like we'd forgotten the impact of all the tariff turmoil on the consumer. Some of the decline, I think, was an overreaction. Royal Caribbean went down on its outlook, but I got to tell you, I checked that one out. I think the expectations simply got too high. People got used to this cruise line just crushing the high end of the estimates. Didn't happen. Now, I felt the same way about Boeing. Now, here's a stock that just hit a 52-week high after giving you almost a double from its low in April. Thank you, Kelly Ortberg. And even though it reported a great quarter with beautiful cash flow, the stock still got hit today. But unlike all the others, just call me a buyer of that one. The rash of takeovers didn't, for once, sour. It didn't create any buying, and not even Union Pacific buying Norfolk Southern, truly creating a continent-wide railroad colossus, assuming the deal gets approved. Now, that's much more likely under Trump than it was under Biden, but there are legitimate antitrust concerns. I think they will get the deal done, but not for a long time. Hence why Target Norfolk Southern saw its stock drop $8.72, although it's still up nicely from when my colleague David Faber broke the story a few weeks ago, when you could still profit from it. Or Baker Hughes buying Chart Industries, GTLS, a very large facilitator of capital goods, including those connected with the selling of LNG, liquefied natural gas. That didn't help either. Nor did the potential combination of Palo Alto Networks, Nikesh Arora, Cramer fave, and CyberArk, a one-time Cramer fave, which is an Israeli cybersecurity company. Not even the incredible earnings news from Cadence Design Systems, also a fave of the show, and Celestica could help things. Cadence, a good partner of NVIDIA, blew away the numbers with a tremendous quarter. But who cares? I mean, we knew their business was great. Same with Celestica, which, along with Sanmina and Flex, belong in an elite camp of contract manufacturers devoted largely to tech. They have more than their fair share of orders. It's a great time to be in that line of work, as we know when we had Flex on recently after their amazing quarter. Long story short, today was a wake-up call. The tariffs, even reduced tariffs, are starting to roil things. The consumer's not spending as much as I thought. There's an acknowledged slowdown there. The bonds, that's right, interest rates are signaling the same. Rates are going down. But how much of that slowdown is because of higher prices, something that bolsters a wait-and-see attitude from the Fed at tomorrow's meeting, and how much is because the consumer's worried and insecure and needs a rate cut? Bottom line, I think it's a mixture of both, but that mixture might not propel the Fed into action. Without a rate cut, though, we could see more quarters like we got from UPS, Whirlpool, and Stanley Black & Decker, all of which are a heck of a lot more important than a Cadence or Celestica, and all which are crying that a rate cut must occur sooner rather than later. It's a conundrum that makes me think the Fed Chief Jay Powell's in a real pickle when he speaks tomorrow. I want to go to Dina in Kentucky. Dina!
Jim Cramer, I'm so excited to talk to you. I'm new at this. I just started in August, and I'm really old, and I have to play catch up on my retirement. And you're my
really
teacher.
old. Let me tell you, I got you beat on that. I know that. I mean, don't even go there. All right, what do you got?
I'm so excited to talk to you. Yesterday, you were just so on fire. I just loved it. I laughed all day long. But listen, my question
well,
is,
yesterday I was an arsonist. Oh, okay.
It was awesome. I laughed all day. My question to you, I was so far up on Netflix, so far up. And now I just hear that it's flattened and it may not go anywhere. And I just need to know from you, should I buy more or should I?
Look, Dina, let me tell you, this is an anecdotal stock. And I think right now people feel like, I don't know, Netflix, what's on? Nothing. I was watching Amazon last night, for heaven's sake. So that's what I think's causing it. Don't worry, it's going to be fine. They're smart fellas. All right, I think the earnings today was a wake-up call. Whether the Fed thinks so, I don't know. We got to wait and see. Mad Money tonight. Merck reported earnings that beat expectations, but the stock fell. What gives? I'm checking with the CEO. Then I'm digging into a new web-based design IPO launching this Thursday, and it's called Figma. I'll give you everything you need to know. And Waste Management, now called WM, beat earnings expectations earlier today. I'm seeing what the CEO has to say about the positive quarter and the stock's forever strong reaction. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.